Hello, everybody. Thanks very much for joining us for today's client conference, which we're hosting as a live stream. And thanks for bearing with us. We're a few minutes late to get going. My name is Urban Müller, and I'll be your moderator. I'll give a short introduction before handing over to our speakers. As for many, the COVID-19 crisis was a shock to our investment strategy. At the same time, it was an intensive learning experience. It pointed out the elements of our process that were thriving and those that were struggling in such a harsh environment. While diversification and machine learning-based forecasts performed well, the reversion-oriented trading that we used at the time caused quite a bit of damage. Today, Thomas, the founder and CEO of Tom Capital, will explain how we adapted our investment process to reflect these learnings and how we have come up with an approach that is more robust and promising. After that, I'm very pleased that our guest speaker, Marcos Lòpez de Prado, will take the stage. He's one of the leading researchers in the application of machine learning to finance. With his groundbreaking publications on the subject and during his direct interactions with our team, he strongly influenced the direction of our development. We always aimed at becoming machine learning supported in every aspect of our investment process. Marcos seems to have found a solution for each one of those elements. He'll take you through some of the ones we already applied, and we'll point some others which we're planning to apply. As your moderator, I'll be picking up the questions you can enter in a corresponding window on your screen and post them to the presenters either during their presentation or at the end, provided we have enough time. So let me hand over to Thomas to get us going.
Dear Urban, thank you for the introduction. And please bear with me too. This is my first time on a webinar on stage. It's quite a new experience to talk to a screen. So I hope this works well. For those unfamiliar with Tom Capital, let me introduce you shortly to the company and then move into topics announced. Tom Capital, as the title stipulates, is all about engineering capital growth. At Tom Capital, we aim to preserve and grow the invested capital of our clients along with ours by investing systematically in diversified futures of the most liquid financial markets worldwide. To achieve our objective, we have committed ourselves to an engineering approach based on scientific methods, transparent findings, and meticulous work. We are a small but very effective team of passionate investment engineers, driving our cutting-edge research and execution. We manage our operational risk through state-of-the-art automation and monitoring systems. We fulfill all requirements for being a licensed asset manager under the Swiss banking regulator, FINMA. So, besides having an excellent team and state-of-the-art infrastructure, why should you invest in Tom Capital? This is our investment proposition. Our objective is to enhance the long-only investment approach for liquid assets. As depicted here in the graph to the left, the long-only investor traditionally seeks to invest in securities with a positive carry. Having some diversification, this might lead to a 50% nominal split between bonds and equities. And this should render him a return of 4.5%, maybe a max drawdown of 30%, 7% value at risk amount. Now, how can we improve on that? It's a step-by-step approach. And the first step, what we change is we start investing in forecasts instead of carries. So by having a forecast on those same asset classes, we can also go short in addition to long. Simulating that through our walk forward, this adds a little marginal to our return expectation, and it reduces the risk. So there comes the second step. In a second step, we are seeking diversification. We are building forecasts for asset classes which don't have carry and therefore are normally avoided by the long-only investor.
So Thomas,
commodities and currencies. Yeah.
Quick question. Why would you not include currencies as an asset class with a carry?
Currencies can have a carry if the interest rate differential between the countries is large enough, different currencies. The currencies we invest in are normally the leading economies of the world, and right now they don't have big interest rates differentials. So if you would take like South African rand, that would have a great risk, but a great interest rate differential. But that's not the currencies we are using in our portfolio. Okay, so by diversifying into those very different asset classes, we keep the same return expectations because our forecasts are about equally good in those asset classes and the others, but we really reduce the risk. So max drawdown goes down to 5% and value at risk goes down to 2%. So then comes the step 3, portfolio construction. So having these tools available, how can we optimize our portfolio? This is something Marcos is going to talk in depth about. And here is our current solution. So we do increase our target exposure from 100% to 300%. And we move from an equal nominal allocation to a risk parity allocation, distributing equal risk to each of those asset classes and in the asset classes to each of the markets. So this increases our return expectations, while also, of course, it decreases the risk, but to a tolerable level and comparable to other investment strategies. Now, importantly, this freedom to construct our portfolio as we feel like, we have because we invest only in futures of the most liquid markets worldwide. So we can go short without having borrowing costs, or we can increase exposure without paying interest rates on lendings. Yep. Going for the free lunch. So we all remember Mokrovitz, the only free lunch we have is diversification. Here's our diversification. It's quite a big lunch. We try to get there. So we are investing in 40 forecasts, a short-term and a mid-term forecast for 20 different markets. And those 20 different markets are in 4 different asset classes. The allocation mechanism is similar to, in a hierarchical sense, as what Marco is going to explain you later. But it's still very primitive in the sense of that it only uses risk parity, and we are moving step by step in the future into optimized allocation mechanism as proposed by Marcos in his different publications. So that is what we do. Now, how do we do it? As mentioned at the outset, we pursue an engineering approach. We break the investment process down into its key elements and find the best fully systematic solution for each one of them. The elements are forecasting, trading, and portfolio construction or diversification. We use data science as proven investment principles to develop those solutions and run them on our state-of-the-art infrastructure. While this framework has remained stable over time, we did adapt the elements based on our progress in machine learning and also our experiences. Starting with forecasting. Marked in yellow, you find our largest or most meaningful breakthrough over the last year. We replaced our manually developed forecasting algorithms with automatically produced ones based on machine learning. This move began in 2019 and was completed in April 2020. On the trading, the second element, We initially intended to do two things. We wanted to extract benefits from the forecast, and we wanted to extract volatility by trading the reversion of the price moves, the short-term price moves. It turned out that the second part, the reversion trading, could not withstand the extreme volatility we experienced this year. Therefore, the reversion trading was discontinued as of April 1, 2020. Our third element, diversification or portfolio construction, benefited from our move to machine learning based forecast because we could add 8 markets and 26 forecasts on April 2020, really increasing our diversification. I will go into the details of these improvements in the following slides. Starting with our forecasting concept. We build algorithms that interpret all available and relevant data daily and systematically. This aims at anticipating the investment decision of short and long-term investors that use the same data, technical, sentiment, and fundamental. Being faster and systematic is our edge. We do not expect to be perfect. Forecasting 60% of all months correctly is good enough for us. It provides a minimal improvement on equity and bonds because they always go up, but a substantial improvement on currencies and commodities. While our concept of forecasting remained the same, our forecasting methodology has evolved. We moved from manually pre-selected data to letting the machine learning program select the data. Marco's algorithms were of great help in doing that. And we implemented all of them in our machine learning processes. We moved from forecasting fixed time horizons to forecasting the trend, something Marco suggested to us in the first workshop we had together. It's called trend scanning, and it's also described in one of his books. Finally, we replaced the manually built algorithms with semi-manually and then fully automatically built ones. These changes not only increased efficiency, adaptability, and diversification of our forecasts, they also led to a breakthrough on how to simulate the past. This breakthrough has a name: walking forward. It is based on the ability of machines to time travel, something human beings cannot accomplish. Imagine you would like to move back in time and develop a forecasting algorithm at the end of 2016. After you accomplish this task, you want to time travel 1 year forward and find out how well your algorithm performed. That would be a great out-of-sample test. But you don't have a time travel machine. So you would have to do something like, oh, I only look at the data until the end of 2016, and then I see how my algorithm performs in 2017. Unfortunately, you know a lot what happened between 2016 and now. And you cannot avoid, sorry, I pressed the button here. And you cannot avoid using this knowledge while developing your forecast. So instead of doing out of sample, you're basically more operating in sample again. Now here, the machine has a tremendous advantage. If you give him the data until 2016, he only uses that data. Has no knowledge of what happened afterwards, can develop his algorithm. You can test it in 2017, and it's a true out-of-sample test. This is exactly what we do. We feed the machines the same data for building all our 40 forecasting algorithms. Oops. And for this, we use 6,000 data series covering all relevant prices as well as economic indicators worldwide. Depending on the market and time horizon to forecast, the machine selects then 30 of 60 of those data series and builds his algorithm. There's very little human bias in that process, assuming that the selection of the data fed to the machine doesn't have strong human bias in there. Moving to forecasts developed fully automatically in April 2020 was a huge step forward for us. Why? For the first time, we can simulate the past with realistic assumptions. So how did this work? Here you have the statistics of our walk forward for the last 14 years on the full portfolio of the 40 forecasts. You see here the percentage of forecasts that were positive. They oscillate somewhere between 25 and 85%. More interesting, when you see the thicker curve there, that's the annual moving average. It never really moves below 50%. And that's very encouraging because it basically stipulates that in most years you will be profitable with such a strategy. When you look at the Corona time, so here you have the 3 weeks following February 21 into the Corona crisis, and you see the performance accumulated over that time from each of our 40 forecasts. Some of them lost substantial money, some of them made good money, but when you look at the portfolio, it hardly budged, didn't move much. So in this crisis, the diversification through the 40 forecasts really worked very well. And this is not a walk forward. These forecasts were produced on February 1, 2020, so long before February 21. I mean the forecasting algorithms, not the forecasts themselves. Now here, we try to depict what did not work during the Corona crisis. As you can see, our well-balanced portfolio is measured in MAR, that's the black and white line in the middle, oscillated around 5% until February 21. Bonds, the green band, had the largest exposure share until then. Starting February 21, the reversion trading mechanism increased the equity position during the equity sell-off, while reducing the bond position in the bond rally. This balanced our portfolio and multiplied the VAR to almost 25%, something that had not occurred in the back test of covering the last 30 years. Finally, the circuit breaker was triggered, and we exited all our positions in order to calmly reassess the situation. The Corona crisis taught us that while the reversion trading can work well for 30 years or more, it does not hold up to such extreme market moves. We do not know when or if this will happen again, but we do know we have to be prepared. Therefore, we gave up reversion trading and to keep exposures constant on each forecast.
Thomas, here in relation to this slide, we have a question, which is what would have happened if the allocations of capital would have been stable through the crises?
Okay, when you look here on 21st of February, actually we had a very nicely balanced portfolio. We had a lot more bonds, we had very little equity, and the result would have been very similar to this one. We had 4 less forecasts operating, but at average, they were about equally good as the full portfolio we have today. So the problem was not the forecast. The real problem was the reversion trading that disbalanced the portfolio so dramatically. Another thing we introduced in April 2020 are risk overlays. We don't want to be prone to very strong market moves in one of the asset classes. One way of doing that is calculating the VAR, the value at risk, and maintaining that below 100% equity level. Okay, no? Yeah, below 100% equity level. Sorry. Boom, boom, boom. Oh, I lost my slide.
Yep. You basically now have to perform. Yeah, now you're back at the.
I'm back at that. So yes, where was I? Yes, below 100% equity level, which would be about 9%, 10%, what an S&P investment would represent. When you look at our simulation here on top, you see that the value at risk in the walk forward is around 5%. It was quite high in 2009 at the end of the bear market. But now we have automatic procedures in place that in case it would get up there again, we automatically would reduce exposure. We are planning similar risk overlays for the sensitivity to dollar, bonds, and equities, so that we really limit the risk of the portfolio. Finally, this is the walk forward summary that convinced us to continue with the strategy after the very difficult start into this year. We believe it is a realistic simulation of how we would have invested in the past without knowing the future. You remember, machines can time travel, persons not. There are no negative years. The drawdown risk is acceptable and returns are good enough. Is this indicative for future returns? No, past simulations never are. However, we, as the major investor in the strategy, we feel comfortable enough to invest our money in this process. And we cordially invite you to join us.
Thanks very much, Thomas. There are a few questions just relating to the prior slides before we get on to the information we share with our investors. One of them relates to investment universe and why. The question is, why do we invest in gold, copper, oil? What are the reasons?
They are a tremendous opportunity of diversification. And that's the major reason to invest in them. And secondly, they move a lot. I mean, copper and oil they move around a lot. So we have very little portions of our capital allocated to them because they represent a very high risk. But when you look at our April live performance in 2020, for example, oil contributed 0.5%, even though we have very small allocation, but we had it short and we could make some money on that one. So we think they're good money bringers.
Right. And the question actually just got refined or precise. I probably read it on my end wrongly. Why only these commodities and not more than oil, gold, and copper?
We would like to add more commodities. And that's in process. And we think we will come up with some more commodities in the near future. However, there's a limiting factor. Commodities tend to be dominated by very few players. And when the data transparency is not given, so in the sense that we don't have access to similar data as the decision makers have, then it might be impossible to find machine learned algorithms that really can add value in the prediction of the market price.
Great. We probably, in terms of time, should soon pass on to Marcos, but maybe one more question that got asked, which is relating to your time travel analogy. You basically refer to not being able for the machines to be able to travel back in time. But the question kind of asks the reverse, which is, did we test applying newer data on old history?
If we want to apply new data to predict old history?
Well, if we train, for example, on a period in the recent past, did we use that particular training to check out the workings of our approach in earlier times? We
absolutely do that. And that's something Marco will enter into too. It's called the k-fold validation. And that's when you use any kind of segment of the data to predict another segment. So you learn on one segment and you predict another segment. And we apply that very intensively in order to find out which parameters make sense or don't make sense.
Got it. Anything else, Thomas, you wanted to convey?
No, I'm just finishing the last 2 slides. So to make it more exciting, we have every 15 minutes an update on our website, on our performance. You can look at that at your handy. So that's for our clients. And you can look at our forecasts, the midterm and the short-term forecasts. We publish them every month. So you can follow and see if that helps you to form your market opinion. That's all. Orban, I hand over to you.
Great. Well, and I'll take the opportunity to pass right on to Marcos, whom I referred to earlier, so that he can get going with his super interesting slides.
Excellent. Well, thank you for inviting me to speak. I would like to discuss some of the methodologies that you described in your presentation. In order to do so, I'm going to share now a PowerPoint where I'm going to explain various methodologies that are useful to analyze, come up with investment ideas and investment processes. All right. The first idea that you mentioned was clustering. What is the key goal that we are trying to accomplish when we cluster? Well, we're trying to identify groups of securities that are very highly codependent among themselves, where codependence could be measured in terms of correlation or any other way of estimating mutual information. And those this set of instruments or variables are very highly codependent among themselves, but they exhibit much lower codependence to the rest. So essentially, the idea of clustering is we need to strike a balance between two opposing forces. What makes two or more variables similar among themselves, but at the same, very different from the rest. You can see here a plot where essentially a clustering algorithm is solving a task that to a human would be relatively simple. And it is, we have various securities that are highly codependent among themselves, and they are recognized as such and put in a particular color, in this case orange, and then other set of securities that are very highly codependent among themselves and different from the rest. For a human, this task may seem trivial. For a computer, it's a non-trivial task until machine learning was developed. Now, imagine doing this in a 10-dimensional space or in a 100-dimensional space. For a human, it would be impossible. But as it happens, if a machine can solve this problem in a 2-dimensional problem, as you can see here, it will also be able to solve it in a 10th-dimensional problem or in a 100-dimensional problem. So that's the power of machine learning. It's able to apply human logic and human-like insight into situations where our brains are not able to operate. We cannot think in terms of 4 dimensions, 5 dimensions, 10 dimensions. But once the computer is taught about the insight of how to solve the problem, it will be able to identify patterns where no human could. There are many different types of clustering algorithms, but essentially you could cluster them. You could classify them into two kinds: partitional clustering algorithms and hierarchical clustering algorithms. So a partitional clustering algorithm is an algorithm that is going to partition, is going to separate the investment universe or the variables into groups where there is no overlap. This variable belongs to one cluster and one cluster only. And every variable belongs to only one cluster. So that's a partition. There are also hierarchical algorithms, and with that, what it means is that there is a tree-like structure that is identified, where every variable belongs to a small cluster, but also to a bigger cluster that incorporates a small cluster, etc. So you can think of a typical tree-like diagram, and that's essentially what the algorithm is trying to solve. These two kind of algorithms present very different properties, and depending on the kind of problem that we're trying to solve, partitional algorithms may be ideal, or hierarchical algorithms may be the ideal one. Now, how can we identify the constituents of a cluster? That's something that the algorithm does automatically. But machine learning is not a black box. It's not necessarily a black box. We can gain a lot of insight into what the algorithm has found. So for instance, what you can see in this plot on the right is we feed a machine learning algorithm various attributes, features associated with animals, with fish, with insects, with mammals. And the algorithm, looking at these attributes, is able to identify characteristics that are common among these various animals. In particular, we'll see that fish are exhibiting certain traits, insects associate in certain traits, mammals associate with certain traits. Without us telling the algorithm what a mammal is or what an insect is, it just happens naturally. The algorithm recognizes that a piranha is very different from a wolf. We don't need to explain to the algorithm what a wolf is or what a piranha is. It just happens that the characteristics that we are passing are informative enough to make this distinction. Now, you can see that here there is something very interesting going on. The explanatory power of the cluster says that dolphins and porpoise are mammals in terms of the characteristics, their attributes. However, they are a strange kind of mammal. Well, that's probably because dolphins are more similar in some sense to sharks than to wolves, for instance. And yet the algorithm correctly identifies a dolphin as a mammal while giving us the caveat, yes, this is a strange kind of mammal. It's not the kind of mammal that I identify in other examples like wolves or pumas or bears or cheetahs, etc. So with that, what I mean is that machine learning is not a black box. It can be used as a black box, but that is our choice. We can, in fact, extract a lot of insight. And if we have any problem with this kind of classification, what we could do is we could override it, or we could force the algorithm to create an additional cluster or remove dolphins and porpoises from the universe. How can we identify different clusters? Well, that's something that algorithms also do automatically. They not only identify what the constituents of the various clusters, they also identify what is the optimal number of clusters. So for instance, in this graph, what you can see is that we pass 5 clouds to the algorithm, and we evaluate how good the clustering is in terms of identifying the sort of exceptions that we saw before, like dolphins, etc. And what it tells us is that there is an optimal number of clusters around 5, right? And these are the 5. while having 6 clusters would not be terribly wrong, having 5 clusters is better. So as you can see, if we start with 2 clusters, which essentially would be these 3 and these 2, the power of the classification is relatively good. Then it decreases around 4, and then it increases around, it spikes at 5, and then it decreases at around 6. So the algorithm clearly recognizes that 5 is the optimal number, but 2 wouldn't be too bad. 2 meaning these 3 and these 2. So again, machine learning gives us insight. It's not a black box, it's a glass box. We can look into what the algorithm has found, and if for any reason we believe that there is a better support, or the data is more consistent with 2 clusters over 5, that's something that we as humans could override. We don't need to take the output of the machine at face value. We can actually analyze it and understand why the algorithm gave us this result, and if we have some sort of doubt or hesitation about the output, we can try and see if there is a better way to, perhaps there is a variable that we could introduce, some dimension that we could introduce that would allow us to make these partitions better. Another concept that Thomas mentioned is feature importance. How can we identify what variables are predictive? What are the sources of information that are conducive to alpha? Well, in machine learning, we have something called mean decrease accuracy. Mean decrease accuracy is very intuitive to understand. Essentially, what we are simulating is what would happen if we shuffle a variable, if we just permutate, we just change the order of the entries in a variable. If we shuffle an important variable, the forecasting power is going to suffer as a result. If we shuffle an unimportant variable, the forecasting power is barely going to be impacted. And that is an experimental way to recognize what variables have predictive power. This is done through cross-validation, as Thomas mentioned. One very powerful application of machine learning is that it disentangles the specification search from the significance search. What does this mean? Well, machine learning is able to answer a critical question, and that is, what are the predictive variables? What variables we should incorporate in our model because they allow us to make better predictions? That is unrelated to what is the functional form, how are these variables binded together. And in classical statistics, it is not possible to separate the 2 questions. The answer to what variable is important is inextricably connected to what is the functional form that connects them. And thankfully, in machine learning, we can separate these 2 questions. We can answer the question, these variables are important irrespective of the functional form. And that is extremely useful because it allows us to formulate proper theories. It allows us to understand what are the variables that are involved in a phenomenon, and therefore make a proposal as to how they are connected.
A quick question that came in relating to MDA, which is, how long does it take for the MDA to eliminate a data series that was consistently predictive in the past until it stopped working one day?
If it is done properly, it will not take many observations in the following sense. If a cross-validation is done with equal weighting, then it will take time. Cross-validation will fail to recognize that the variable is no longer important. Why? Because in cross-validation, there is no sense of forecast decay, or that these observations happened a long time ago. So unless we inject information into the cross-validation about how old the observations are, the cross-validation is going to consider that all of these observations happen at the same time.
Right.
But if we conduct cross-validation properly in a time series, meaning that we inject information about how old the observations are, then cross-validation will pick and recognize, well, this variable used to be very predictive a year ago, but over the past few months is no longer predictive. So the answer is, it depends how cross-validation is done. If we incorporate time series information into the cross-validation, then this time series information can be taken into account.
Got it, thank you. And then maybe a question going back to clustering. How do we determine the optimal number of clusters in hierarchical clustering? Can we use the same idea as k-means?
Yes, and that's a wonderful question. In a partitional clustering algorithm, the number of clusters, it's obvious, because when we evaluate the performance of the clustering algorithm, we are already imposing a particular number. So we essentially say, what is the quality of the clustering if we have 3 clusters, if we have 4 clusters, if we have 5 clusters? So in that sense, it is an evaluation of multiple alternatives. That is in a partitioning algorithm. In a hierarchical clustering algorithm, because all the clusters are subsumed and form part of bigger clusters, there is no direct way to do this. However, what we can do is we can produce this kind of plot for different distances. Essentially, what we do is we go to the dendrogram, the tree-like structure, and for various distances, we form the partitions. So you can think of a hierarchical clustering algorithm as a sort of Russian doll game, where one doll is within another doll, and what you need to identify is at what level you want to make the partition. So in summary, every hierarchical clustering can be transformed into a partitional clustering. The reverse is not true. Partitional clusterings cannot generally be transformed into hierarchical clustering, but you can always go from a hierarchical clustering to partitional clustering, and therefore determine the optimal number of clusters. If this sounds complicated, you can see in my book, this explains how you can do it, how you can go from hierarchical clustering to partitional clustering.
Thank you.
Excellent. So let's talk about cross-validation. And Thomas referred to this. The idea of cross-validation is essentially to extend the notion of walk-forward backtesting that Thomas mentioned. In a walk-forward backtest, what we do is we keep incorporating information and making a forecast about the future, where we only take information about the past. And that is a wonderful way of backtesting. But this is not the only way of backtesting. Cross-validation backtesting, what it means is that now we are going to treat the observations as scenarios, where sometimes we use information about the future to predict the past. Of course, when I say predict the past, it means that the algorithm doesn't know the past. Predicting a past that you already know, that would be trivial. Now, the situation is, for instance, suppose that you train an algorithm with observations from 2009 to 2019, and this algorithm, of course, is going to believe that the market is always going up. And then you test this algorithm on 2008, and the algorithm is going to suffer, right? So it is in a scenario simulation where the historical path is one of the paths that you are evaluating. So this does not mean that cross-validation backtesting is better than walk-forward backtesting. It is 2 different ways of backtesting, and you can learn something from both. Then the important aspect of significance analysis, that you can interpret the results. You can identify what are the variables that are truly relevant to your models and produce a theory accordingly. Suppose, for instance, that we take a time machine, as Thomas mentioned, and we go and visit Sir Isaac Newton. He's in quarantine during the bubonic plague. I guess he also had to stay at home for a while, and he's thinking about why apples are attracted to the earth, right? And he starts to hypothesize about various variables that could explain this phenomenon. It could be related to the mass of the objects, but also the shape, could be the color, it could be the density, it could be a number of variables he doesn't know, right? Well, machine learning, if he have had access to computers, would have answered that question really simple. It would have evaluated the various candidate variables, and it would have produced this sort of result where it would have recognized that really two variables were involved in this phenomenon, and only two. And this is mass and distance. And the rest, density, shape, etc., would have no significant, no material effect. So that's essentially what we are trying to do with machine learning. We're trying to identify the ingredients of the theory. A machine learning algorithm will never give us a theory, but it will give us the ingredients that we need to take into account in order to form our theory. And this sort of approach, cross-validation, is very helpful in order to prevent selection bias. Why? Because it allows us to consider many different paths where we are not able to overfit a particular path, right? When you are cross-validating hundreds of alternative paths, it is becoming harder and harder to identify a particular trading rule that would have been successful just by luck. It's always possible, but it is becoming increasingly more difficult. So that's an advantage of cross-validation backtesting over historical backtesting. And there are many flavors and ways of doing cross-validation. Another important aspect of cross-validation is that it can take care of substitution effects. What do I mean with substitution effects? Well, when you have two variables that appear to be very highly correlated, it's hard to identify which one is important. In fact, you would have to take both together, right? Because there is an overlap, there is a mutual information that both variables share, and it's very hard to separate the two. You have to take them together. And that's where clustering comes comes really handy. You can identify what variables share a significant amount of information, cluster them together, and therefore make a significance analysis. This is much better than the classical way of conducting significance analysis, which is regressions, right? Typically in regressions, when you have a phenomenon which is called multicollinearity, essentially when you have substitution effects, it's really hard to separate variables. But thankfully, with machine learning, thanks to clustering, we can take care of the substitution effects. And now let's go to portfolio construction. Whenever we have a portfolio of various systems and algorithms, we need to put them together into a portfolio that is well diversified, as Thomas mentioned. And machine learning is very helpful in that too. Why? Because it solves two very important problems in portfolio construction. The two problems are related to instability. Markovitch solutions are unstable for two reasons. Number one, because covariance matrices are very noisy. Finance is very well known for exhibiting a low signal-to-noise ratio. Why? Well, as a result of arbitrage and competition, everybody is trying to extract alpha, and as a result, there is very little signal left in the market. And as a result, covariance matrices are extremely noisy, and this makes the Markovitch solutions very unstable. Another source of instability that is rarely recognized in finance is signal-induced instability. Yes, even signal can be a problem. Not only noise can lead to suboptimal results, also signal. There are certain types of signals that make portfolio optimization suboptimal and that can confound Markovitch. In particular, the most common kind of signal is extremely damaging to Markovitch optimization, and that is clustering. Think of stocks that are organized around sectors and countries and regions and industries, etc. These are stocks that share a lot of information, and that this makes Markovich very confused. Why? Because it doesn't know whether it should allocate to bank A or bank B, where the two banks are very highly correlated. And this creates an instability. A very small change in the forecast of a bank will mean that all of the allocation goes to that bank. And as a result, Markovich incurs in tremendous transaction costs. So what can we do to resolve this? Well, we can apply clustering to bundle together stocks that are very highly correlated and apply Markovich on each of these clusters. So this is what I'm explaining here in step one. First, we cluster the investment universe. Then we optimize each cluster separately. This allows us to reduce the diversity of the system, working with, let's say, 1,000 stocks. If we have 10 clusters, now we are working with 10 by 10. So we are working with a covariance matrix of 10 by 10. Essentially, we have reduced the dimensionality of the problem from 1,000 to 10. Then we do a second pass. We do a second optimization on the reduced system, and the optimal allocations will be the product of the two. So this is essentially, this allows us to improve over Markovich optimization by transforming an imposed problem, a problem where all of these stocks are very highly correlated, into a problem that is well posed, where the clusters are not correlated among themselves, right? That is what makes a cluster. When there is a group of stocks that is very highly correlated among themselves, but it exhibits little correlation to other clusters. And well, does this work? We can conduct Monte Carlo experiments and also historical simulations, but even better, Monte Carlo experiments, and determine how better this approach is compared to classical methods. And if you do that, you will see that, in fact, machine learning-based portfolio construction can reduce the mean square error by around 50%. Whether you're computing a minimum variance portfolio or a maximum Sharpe ratio portfolio, what you will get is that the variance, essentially the mean square error of your forecast is 50% what you would get with Markovich. Finally, let me conclude with a few words about overfitting. This is the main caveat that we have in systematic investing, whether it is classical statistical methods like regression analysis or machine learning. We have to be very keen on avoiding overfitting. And there are two kinds of overfitting. There is the overfitting that occurs on the train set, the observations that you use to calibrate your model, and on the test set, the observations that you use in your backtest. Yes, the fact that that you are not using observations in your calibration of the model doesn't mean that you may not overfit on the test set. Why? Because once you look into the outcomes on the test set, you could use these outcomes to recalibrate your model in the past. So we have to be very aware of these two kinds of overfitting. There are two kinds of overfitting, not one, two. Why? Because there are two kinds of sets, train sets and test sets. The train set overfitting is very well understood. There are multiple techniques to prevent it. The test set overfitting is much less understood. Essentially, what this means is that if you conduct many different backtests, eventually you are going to identify one backtest that looks good. But that does not mean that the strategy is going to be profitable. Why? Because every backtest has a probability of a false positive, and if you just keep trying multiple times, eventually a false positive will come up. What you need to do is you need to take into account all the backtests that have taken place so that you can discount the probability of a false positive. And essentially, this diagram summarizes what I just said, that there are two kinds of overfitting, and there are many different machine learning methods to prevent overfitting on train sets and test sets. And with that, I will stop. Thank you again for the opportunity, and I will welcome your questions.
One question from my side, Marcos. When you look at the separation between test set, validation set, training set, and unknown, unseen, this validation separation, could you do the same thing if you would do a manual forecast algorithm development? Because you say separation is important.
And that is...
Sorry?
Absolutely. Yes, absolutely. And that is something that is very useful in machine learning. You can always look into what the algorithm is doing, and you can interact with the algorithm. So for instance, if you're doing convex optimization, you cannot really manipulate the inners of the algorithm. You cannot take the covariance matrix and start changing things, because the covariance matrix is going to be inconsistent, and that makes other methods like convex optimization kind of you can use it, but you cannot change it. You cannot adapt it to your needs. That's something that you can always do with machine learning. You can actually manipulate things and see if a different scenario could have performed better. For instance, you could take its certain partition of test set and train set and change the partition to incorporate information about market regimes or about economic information that you know from other analysis. You can incorporate that information and repeat the analysis and see if that produces a new insight.
One last question on clustering and PCA. PCA as a principal component analysis is one way of organizing your data. Clustering is another way. Which one do you prefer?
I like both. You have to understand what are the objectives of each. The objective of PCA is to identify a new rotation of the dimensions that allows you to maximize the variance explained while keeping the various dimensions orthogonal. So now the axis will be orthogonal, and you can explain as much variance as you can. So it's a wonderful linear algebra tool. Clustering is different. If you want, you could think of PCA as a geometric approach, an approach that is based on angles and is based on vectors. And clustering is more of a topological approach. It's more modern. The idea of clustering is it incorporates a lot of information about the variables involved that goes beyond angles and correlations, etc. It incorporates information about attributes, and in particular, it does not require a change of basis. What does this mean? It means that when you do a clustering, you are still operating with the original variables. You're still working with the stocks that you are trying to put together in a portfolio. That is not true in PCA, right? Once you do PCA, you change the basis, and now you're working with linear combinations of securities, which is extremely hard to interpret. So both approaches are correct. Of course, it's math. You have to understand what is the objective of each approach and see what is the ideal for your particular problem.
Okay, thank you very much. Urban?
Well, I think unfortunately the hour, at least from my perspective, went by super fast, and we're thus at the end of this particular client conference webinar. We thank all the people who've attended for doing so. We will make the replay available on our website. And we did not get to, unfortunately, to answer all the questions. So if there are additional questions which we were not able to answer, you can easily ask them to us via info@tomcapital.ch. You can also give us a ring. You find the information on the website. We wish you a good continuation of your day and the rest of the week. Thanks again, and take care.
Thank you very much. Bye-bye.
Bye now.